Everyone's talking about short squeezes again. Reddit is going crazy over Beyond Meat and GameStop, and it can look like chaos driven by FOMO. But behind the scenes, it's actually being controlled by software. So let's take an insider look at what's actually going on in these systems. I'm Josh, software exec, former engineer, founder, and consultant, and on this channel, we crack open the secrets of the software industry. Today, we're going to go inside some of the machines that move markets and how the software behind ticker tapes and algorithms and news analysis can actually create these wild market movements. We'll cover how data flows through the nervous system of a market, how algorithms read and react to news, how hedge funds and market makers view this from the inside, and how all of these systems can spark or amplify short squeezes like what we're seeing with BYND. So let's get into it. Every price tick you see on CNBC or Robinhood or anywhere, it comes from a massive real-time data system. In the old days, this was a literal ticker tape, an actual tape printed out and run. Today, it's more of a microsecond level, like fire hose of updates in binary, right? So there's something called the consolidated tape, which combines all the trades across all the exchanges, which is generally what turns into the price data that you'd see on places like Fidelity or Robinhood when you check your app. But professional firms, they use what's called direct feeds. These are low latency data straight from the exchanges like NASDAQ or NYSE. Each exchange provides their own feed because speed is critical when making market decisions, especially when it comes to things like high frequency trading, right? Millisecond can cost millions. So these direct feeds, they aren't formatted in nice, easy to read ways. They're utilizing every byte, every bit to store information in a super dense way that is then read by specialized software and actually sometimes even hardware that's designed specifically for these feeds, right? It reads them byte by byte, real time as they hit the system. So let's go over an example. If you're familiar with computers or how they exchange data, you might be thinking of systems that send data that look something like this, or possibly something like this. So you might be expecting a ticker tape to format the data similarly. But these ultra low latency feeds, they need to use every byte sparingly. So these direct from the exchange feeds are probably going to look something a little more like this. And what you're seeing here is pure hexadecimal. That's just really another way of displaying binary, aka the zeros and the ones that a computer uses, but divided into bytes. So to you and I, it pretty much looks like gibberish. But each byte has a purpose, something like a timestamp or a transaction type or a ticker symbol or price. And because these packets are so small, so compressed, they are sent super quick, lots of them all at once, over a wire to machines that translate that or even act on it. It's also why firms spend literal fortunes laying fiber in perfectly straight lines from New York to Chicago. And part of the reason why trading firms used to want physical locations as close as possible to the exchange, right? Because it actually takes physical time for electrical impulses to travel through a wire. And that time, right, the distance that ticker has to travel, that makes a difference whose algorithm gets to trade first. So fiber optic cable makes a lot of that old data cable stuff, like coaxial cables, kind of useless because now data is traveling at near light speeds. But it's still important for them to optimize their data for travel. Effectively, it's an arms race for speed, and whoever gets the data first gets to trade first and wins. But price alone isn't enough. See, markets move on information, right? Press releases, earnings, reports, even tweets. And trading firms use what's called NLP systems, that's natural language processing, to analyze the news in real time and translate what's happening in an article to signals that say this is a positive thing, this is a negative thing, buy or sell. And you might be thinking, oh, that sounds a lot like AI. But NLP has been the tech that's been used for decades. It's actually probably closer to like that sentence diagramming stuff that you used to do in school rather than AI. So effectively, what they do is they sit on a news wire, actually hundreds of news wires, like things from Bloomberg, and they monitor the direct mentions of companies or tickers, or whole industries and market segments, or even global news like hurricanes and conflicts. And then they score the sentiment of what's in the article, whether it's positive, neutral, or negative, and they automatically adjust their positions or place trades based on that massive collection of real-time data. So if an algorithm reads, for example, Beyond Meat short interest doubles, it might scale back the short positions a little bit to avoid risk. And if it sees analysts upgrade Beyond to buy, another model might trigger a momentum play almost instantly. So remember, these are real-time systems. They're streaming systems generally built on the fastest tech available. Generally, it's really low-level things like custom C and C++ engines that are optimized for sub-millisecond delay. And what that means is, so in your daily life, generally the smallest time frame you'd think of is seconds, right? Now, if you're used to dealing with computers, you might be familiar with thinking in milliseconds, which is a thousandth of a second, and generally the fastest you'd really ever need to worry about in computer time. But in news and ticker feeds, code is graded in nanoseconds. It's a millionth of that. And that's what I'm talking about here when I say something is moving at wire speed, right? There's no real noticeable difference between the data running through the wire uninterrupted versus being parsed. And that means it needs sub-millisecond timing in the nanosecond range. So anyway, you've got all these algorithms sitting on these wires, competing to be the first to trade on the news. And when these algorithms all see the same bullish signal, they all pile in one on top of the next, and suddenly the market starts to move. And that right there can be a foundation for a squeeze, right? And it's also one of the reasons why you tend to see those candles on charts where suddenly there's millions of shares traded on a tick where previously there were only hundreds or thousands. But to understand the full picture, you really have to look at who's running these systems. And there's two major players here to understand. The first part is hedge funds. So from a hedge fund perspective, the mission is really simple. It's to find an edge. And often that edge comes from the software they're running. See, hedge funds build or buy systems that can read market data faster, interpret it smarter, and execute trades before the rest of the world even knows what's happening. And for a long short equity fund, software is used to manage exposure, right? To strike a balance. So let's take a look at a shorted stock, right? So say a shorted stock starts showing positive sentiment in those news wires, right? Say some good news coverage or rising retail chatter. Their software will detect that and maybe it'll start reducing their short position automatically. So what that is, that's not manipulation, that's just risk management, right? They're trying to avoid getting caught in the squeeze. But here's where it gets interesting. When one fund's system starts buying to cover seeing that risk, other funds' algorithms see that buying and may interpret it as a bullish buying signal. So they might now join in on the buying. And so now we're building buying pressure and it multiplies. Right now, what started as simple risk management starts to become a chain reaction. And that's the moment when a squeeze can begin to form. Right? So they didn't start out trying to fuel a fire. They were initially trying to just put one out. But when every fire extinguisher is spraying gasoline, then you end up with potentially the next GameStop. So now let's talk about the market makers, the ones who sit in the middle of all of this. Market makers like Citadel or Virtue, they are the plumbing of Wall Street. Their job is simply to keep the market liquid, meaning that there's always a buy available for every sell and a sell available for every buy so that the trades can happen instantly. Now, to do that, they also need to use ultra fast algorithms, right? And these algorithms are going to match the buyers and the sellers. They're also going to hedge their own exposure in real time and constantly kind of adjust the prices based on demand and volatility. So what happens from the market maker angle with that example before where a hedge fund started covering and kicking off a squeeze? So first, the order flow is going to spike up a bit, right? The spread is going to widen and volatility is going to start to really shoot up. But the market maker's software is designed to try to stay balanced. So when the short covering surges, they have to scramble to hedge options positions and balance off their books, which means that their own algorithms have to now start buying the stock as well in order to stay delta neutral. And that adds even more upwards pressure, right? So from their side, they're not betting against the stock or for the stock. They're just trying to survive this massive storm that's coming their way and stay flat. But that itself can add buying pressure to add to the cascade. And now suddenly what started as retail interest turned into an algorithm auto covering for a firm, which clicked off a bunch of other firms auto piling in to the buys, and then market makers algorithms buying in too to keep them balanced. And now you're in this whirlwind of upward momentum being controlled and caused almost entirely by wire speed algorithms. So here's the basic chain reaction, right? First, the shorted stock starts rising a little bit, right? Maybe news sentiment turns positives. And then algorithms detect that shift, and hedge funds, maybe just one or two at first, they start to cover their shorts. But then other hedge funds start piling in when they see that positive pressure and continue to build. And then the market makers automatically adjust the order imbalance and start also triggering price rises, which causes the price to further rise, which triggers more algorithms to cover more shorts, which triggers more buy pressure. It's kind of the infinite repeating loop that feeds on itself. And so what we're seeing, it's not necessarily coordination, it's just this weird emergent behavior, right? Thousands of independently trading systems all tuned into the same triggers, right? Volume, volatility, sentiment, and they're all reacting the same way in sync. So squeezes used to be human driven, right? Emotion, fear, greed. But now, currently, they're software driven. Things like logic and latency and machine learning. But going into the future, we're starting to see things with generative AI, right? Building its own sentiment models, even writing its own news articles based on what's going on, sometimes with no human intervention at all. And we might see these feedback loops start to get even worse because it's not going to be the market algorithms reacting to the news. They're also going to be making the news that they're reacting to, right? So AI written articles, fake social chatter, predictive headlines, all these things feeding algorithms designed to act before anyone can verify the story. And these stories being written by algorithms themselves. Effectively, we're already starting to see a world where markets are, in part, machines talking to machines. And humans, we're just here riding the waves. So if you found that helpful, please like the video. Have you ever been caught up in a short squeeze before yourself? Drop a comment. And if you'd like to see more videos on the software and the tech industry, follow the channel. There'll be more coming soon.